Ladies and gentlemen, imagine waking up in 2026 to a world where the metal we've all overlooked for years, silver, has reshaped fortunes, rewritten portfolios, and created a class of investors who quietly became multimillionaires. Today, I'm not talking hype. I'm talking fundamentals, price history, and the unstoppable logic of macroeconomics. Most people become wealthy in commodities not because they are smarter than everyone else, but because they are willing to look where others refuse to look. That is the essence of opportunity. When an asset is ignored, underowned, and misunderstood, that is usually where the seeds of enormous wealth are quietly planted. Silver today sits in exactly that position. For years, investors have been distracted by technology stocks, cryptocurrencies, artificial intelligence, and whatever the latest fashionable trend happens to be. Meanwhile, silver has remained in the background, traded yes, but not loved. And I've learned something over decades of investing around the world. When nobody is excited about an asset, when television rarely talks about it, when cocktail parties are silent about it, that is often when the real opportunity exists. Silver is historically cheap relative to many financial assets. Look at long-term charts. Look at its inflation-adjusted highs. Look at its ratio to gold. There have been periods when silver dramatically outperformed nearly everything else because it had fallen too far out of favor. Markets move in cycles. They always have and they always will. When something becomes excessively popular, it eventually corrects. When something becomes excessively neglected, it eventually surprises. Right now, silver remains well below levels that history has shown it can reach during periods of monetary stress or commodity bull markets. That doesn't mean it will go up tomorrow. Markets rarely move on our schedule, but it does mean the asymmetry is compelling. When downside risk is relatively limited compared to long-term upside potential, that is where rational capital should start paying attention. Another critical point is psychology. Majority of investors buy when prices are high and headlines are euphoric. They feel safe whenever one agrees with them, but true wealth is built by doing the uncomfortable thing. Buying when prices are low and sentiment is indifferent or negative. Silver today does not inspire euphoria. It does not dominate headlines, and that is precisely why it deserves serious consideration. History shows that commodity bull markets tend to be powerful and often last longer than people expect. Once momentum begins, capital flows in waves. First, the informed money, then institutional capital, and finally the public. By the time the public arrives, the biggest gains have usually already occurred. The intelligent investor positions before the crowd, not after it. Silver also carries a unique characteristic compared to many other assets. It is both a monetary metal and an industrial one. That dual identity creates powerful leverage when economic conditions shift. In times of monetary uncertainty, investors seek tangible stores of value. In times of industrial expansion, demand increases for practical usage. When both forces align, price movements can accelerate quickly. What creates multimillionaires in markets is not day trading or chasing headlines. It is recognizing long-term structural mispricing. Silver has experienced extended periods of consolidation, frustration, and sideways movement. Those phases test patience, but they also build the base for significant moves. The longer an asset remains compressed, the more energy it stores for eventual expansion. Think about it logically. Global money supply has expanded enormously over the past decade. Debt levels have reached heights that would have seemed unimaginable years ago. Currencies naturally lose purchasing power over time when supply expands faster than productivity. In that environment, tangible assets tend to reprice. They do not need excitement. They simply respond to monetary reality. Silver supply is not infinite. Mining production faces constraints. Discoveries are not increasing at exponential rates. Meanwhile, investment demand can change rapidly with sentiment shifts. When supply is steady but demand rises, the mathematics become straightforward. Contrarian investing requires patience, discipline, and emotional control. It requires the willingness to look foolish for a period of time. Those who bought commodities before past bull cycles often endured months or years of doubt before being proven right. But when the cycle turned, it turned decisively. If silver enters a sustained bull phase driven by monetary instability, industrial demand, and capital rotation out of overvalued financial assets, the upside could surprise even seasoned investors. Percentage gains from undervalued hard assets can be dramatic because they begin from suppressed levels. The key is not blind optimism. The key is rational analysis combined with historical awareness. Markets overshoot in both directions. Silver has spent years below the level that long-term fundamentals might justify. When correction of that imbalance begins, it rarely moves in a straight line, but it can move with force. Those who recognize undervaluation before it becomes obvious are the ones who change their financial trajectory, not because they gambled, but because they understood cycles. Silver today represents a classic cyclical opportunity, neglected, relatively cheap in historical terms, and positioned within a global macro environment that favors tangible assets. Fortunes are rarely made by following consensus. They are made by studying history, observing cycles, and acting with conviction when logic outweighs emotion. Silver may not be fashionable, it may not be glamorous, but the markets do not reward fashion. They reward foresight. And when the crowd finally wakes up to an asset it once ignored, the revaluation can be swift and transformative for those who are already there. If you want to understand where silver is headed, you don't begin with the metal itself, you begin with the world. Markets do not move in isolation. They move because of forces much larger than any single asset. And today, those forces are building quietly but powerfully beneath the surface of the global financial system. Look around. Governments across the world are carrying debt levels that would have been considered catastrophic a generation ago. Central banks continue to intervene in markets manipulating interest rates and expanding balance sheets whenever stress appears. Currencies are being diluted, purchasing power is eroding, and yet most people behave as though this is normal. It is not normal, it is late cycle behavior. When you print money aggressively and suppress interest rates for long periods, you distort capital allocation. Investors chase yield in places they normally wouldn't, asset bubbles form, and eventually confidence in paper assets begins to weaken. History has shown this repeatedly, from ancient empires debasing coinage to modern governments expanding fiat supply. The outcome is always the same. Tangible assets regain relevance. Silver sits directly in the path of this macro shift. It is not just a commodity, it is a monetary metal with thousands of years of history as a store of value. When confidence in financial systems wavers, investors instinctively return to what cannot be printed. They return to what is finite, tangible, and universally recognized. What makes the current environment particularly compelling is the scale. Global money supply has expanded dramatically over the last decade. At the same time, geopolitical tensions are rising, trade relationships are shifting, and economic stability feels increasingly fragile. In such conditions, diversification into hard assets is not speculation, it is prudence. There's also a dangerous complacency in financial markets. Many investors have grown accustomed to central banks stepping in whenever markets falter. They assume liquidity will always be provided, volatility will always be controlled, and risk will always be cushioned. But cycles eventually overwhelm intervention. Confidence can erode faster than policymakers can respond. Silver tends to move when trust begins to crack, not necessarily at the first sign of trouble, but when awareness spreads. It is during these transitions from complacency to concern that capital rotates. Investors who are comfortable in equities or bonds start reallocating toward real assets. And because silver's market is relatively small compared to global financial markets, even modest capital inflows can have disproportionate price impact. Another powerful force at work is currency competition. Nations are exploring alternatives to traditional reserve systems. Trade blocs are diversifying settlement mechanisms. When the dominance of any single currency is questioned, monetary metals often benefit. They represent neutrality. They are not tied to one government's fiscal policy or political agenda. At the same time, inflationary pressures remain embedded in many economies. Even if headline inflation cools temporarily, structural costs, energy, labor, and supply chains remain elevated compared to prior decades. Inflation does not need to spiral out of control to support silver. It simply needs to persist above comfort levels. When savers realize their purchasing power is steadily declining, they seek alternatives. There's also the issue of real interest rates. When inflation outpaces nominal yields, holding cash or fixed income instruments becomes less attractive. Investors search for assets that can preserve or enhance purchasing power over time. Silver historically performs well during such periods because it represents an alternative monetary anchor. Importantly, macro transitions do not announce themselves loudly at first. They build gradually, debt accumulates quietly, currency purchasing power erodes slowly, policy distortions compound over years. But when the tipping point arrives, markets adjust rapidly and assets that were ignored can reprice aggressively as capital scrambles to reposition. The remarkable aspect of silver is that it has not yet fully reflected these macro pressures in its price relative to historical extremes. That creates an asymmetry. If global stability continues perfectly, which history suggests is unlikely, silver may remain steady. But if monetary instability increases, If currency confidence declines, or if inflation expectations reaccelerate, the repricing could be substantial. We are not talking about short-term trading volatility. We are talking about structural forces, debt cycles, currency debasement, geopolitical fragmentation, and shifting trust in institutions. These are not temporary headlines. They are multi-year trends. The intelligent investor studies history. Every major debt expansion in history has ended with either default, restructuring, inflation, or currency adjustment. None have ended painlessly. In those environments, tangible assets historically regain prominence. Silver stands at the intersection of monetary stress and global economic transition. It does not require panic to move. It requires recognition, and recognition spreads slowly until suddenly it spreads quickly. When macro forces align, price becomes the messenger, and by the time the message is obvious to everyone, the opportunity is often far advanced. Those who observe the structural imbalances early, who understand the implications of debt expansion and currency dilution, position themselves before the shift becomes consensus. The world is changing financially. Capital will seek safety, tangibility, and resilience. When it does, assets with intrinsic value and historical monetary legitimacy tend to respond decisively. Silver's role in that transition should not be underestimated. If you want to understand silver's true potential, you must look beyond the headlines and examine the mechanics of supply and demand. Markets ultimately move because of imbalance. When demand grows steadily while supply struggles to respond, price becomes the adjustment tool. And in the case of silver, the structural dynamics are far more interesting than most investors realize. Silver is not merely a monetary metal sitting in vaults. It is a critical industrial component embedded in modern civilization. It is used in electronic semiconductors, solar panels, medical applications, electric vehicles, and countless other technologies. Unlike gold, which is largely stored and preserved, much of the silver used industrially is consumed. It disappears into products often unrecoverable at economic cost. That distinction matters. When a metal is both a store of value and an essential industrial input, it carries dual demand engines. If economic activity strengthens, industrial demand increases. If financial instability rises, investment demand increases. When both occur simultaneously, pressure builds. Over the past decade, the world has accelerated its transition toward electrification and renewable energy. Solar capacity has expanded dramatically. Each solar panel requires silver for conductivity. Electric vehicles rely on silver in their circuitry. As technology becomes more advanced and interconnected, silver's conductivity and reliability remain indispensable. Substitution is limited because few materials match its physical properties. At the same time, mining production is not expanding at explosive rates. Silver is often mined as a byproduct of other metals like copper, lead, and zinc. That means silver supply is partially dependent on the economics of entirely different markets. If base metal production slows due to economic weakness or lower prices, silver supply can tighten unintentionally. Exploration budgets across the mining industry have fluctuated significantly over the years. Discovering and developing new mines takes time, often a decade or more. Regulatory hurdles, environmental restrictions, and capital constraints further delay expansion. Supply does not respond overnight to price signals, it lags. Now, consider the investment side. The silver market is relatively small compared to global equity and bond markets. A minor reallocation of institutional capital, even a fraction of a percent, can represent billions flowing into a constrained physical market. When investment demand accelerates during periods of macro uncertainty, it can amplify existing industrial tightness. History provides examples of how quickly silver can move when momentum builds. Price increases are rarely linear. They often begin gradually, then accelerate as awareness spreads. Early participants accumulate quietly, then traders notice, then the media notices. Finally, retail investors arrive. By that stage, much of the move has already occurred. The interesting aspect of silver today is that industrial demand trends appear structural rather than cyclical. Electrification, renewable energy, and digital infrastructure are not temporary fads. They represent multi-decade transitions. Even if economic growth slows periodically, the long-term trajectory remains upward. Meanwhile, above-ground inventories are not limitless. Governments once held large strategic stockpiles of silver, but many of those have been depleted over time. Private inventories exist, of course, but they can shift from available supply to long-term holdings quickly if sentiment changes. Another factor to consider is the gold to silver ratio. Historically, there have been periods when silver dramatically outperformed gold after extended stretches of underperformance. Ratios tend to revert toward historical norms over time. When they do, the percentage gains in silver can be substantial because it is starting from a more compressed base. Volatility in silver is higher than in gold. That discourages conservative investors, but volatility cuts both ways. It magnifies declines and advances. In strong bull markets, silver's upside movements can exceed expectations precisely because of its smaller market size and dual demand drivers. The global push toward green energy infrastructure alone requires significant silver input. Governments are allocating enormous capital toward renewable projects. Corporations are investing heavily in battery technology and energy storage. These are capital-intensive industries that rely on reliable conductive materials. Silver remains one of the best available. When you combine industrial consumption and